Turning hard times into good times. I'm your host, Jay Taylor, and as I like to remind you each and every week, I'm also the author of a newsletter called Jay Taylor's Gold, Energy, and Tech Stocks. And my company, Taylor Hard Money Advisors, is in partnership with Chen Lin, who publishes What is Chen Buying, What is Chen Selling. And you can go to miningstocks.com to buy either of those newsletters. You do need to put your name on a waiting list for Chen. Miningstocks.com. Put your name on the waiting list for Chen. You can subscribe to mine anytime, but Chen will be accepting new subscribers at the beginning of the next calendar quarter. I want to thank each of you for listening to this show and invite you all to send your questions and comments along to questions4taylor@gmail.com. Questions, the number 4, taylor@gmail.com. Also, follow me on Twitter at jtaylormedia. I want to thank our sponsors for making this show economically viable. Our sponsors for today's show are Carlisle Goldfields RN Resources and Cornerstone Capital Resources. Before I introduce the topics of our main guest today, I want to pass along a few remarks from some market analysts that I hold in very high esteem, because I think they are outlining some potential cataclysmic market changes that we may be on the verge of enduring, and if we are not ready, we could be facing some very significant losses. First, I'd like to point out a chart that I showed in my weekly newsletter. It is a chart that shows the insider holdings. These are U.S. Treasury broker-dealers' holdings of U.S. Treasuries. There was a precipitous drop of these insider holdings of U.S. Treasuries with the Lehman Brothers debacle, with the financial crisis of 2008-2009, and then from then on it's continued to go lower. So it was just about 18% of the total treasuries were held at the peak by these insider broker-dealers, and now it's a mere slightly over 4%. It's a precipitous drop, and the interesting thing is this was on the rise all during the bull market of the treasuries. It started back in about 1981 or 1982 when interest rates were double digits. So we've had a spectacular bull market in bonds that have lasted some 30 years, and what this is suggesting to me is that it may well be coming to a close. If we are on a major change in interest rates, and interest rates have been heading higher, sovereign debt rates have been heading considerably higher, percentage terms higher, starting with the Bund, the German Bund, and now the U.S. Treasuries. And so the big question is whether or not the central banks are losing control of the bond markets. Well, James Turk went on King World News a couple of days ago talking about an impending derivative blow-up, most likely related to a most certain Greek default. There can be no question that the Greeks are going to default. And referring to the spot silver market, James was suggesting that silver is the most underpriced asset in the world right now. And I might mention that we do expect to talk to James Turk along with Roy Sebeg of BitGold next week. Both of them should be with me together on this show, and we're going to be talking about BitGold and other related topics. Then there's David Kranzler, who publishes a very insightful blog at investmentresearchdynamics.com. I'd encourage you to go there and read his latest piece. It's called A Derivatives Bomb Exploded Within the Last 2 Weeks. Now, he is talking about some very interesting points that lead him to believe that, in fact, something is going on underneath the surface, being hidden from the mainstream, being hidden from the average investors by the elite. First of all, he notes that the S&P and transports have seriously diverged since the end of April, with transports heading substantially lower. Transports, of course, measure the heartbeat of the economy. So with a massive decline in stock prices of trucks, trucking companies, railroads, delivery services, it indicates that the real economy is not doing very well. Well, indeed, we did see a negative 0.7% GDP in the first quarter. Unusual negative correlation, everything David pointed out, unusual negative correlation of 10-year treasuries with transports. If rates were rising as a result of a strong economy, then transport stocks should rise in reflection of that strong economy. But in fact, the 10-year treasury rates are rising rapidly, even as the transports, as we just noted, are sinking and are doing very poorly. So this suggests to Kranzler, and I agree, that the Fed is very well maybe losing control of interest rates. In fact, that there is some panic in the markets, which again would go to this notion that Turk was suggesting of a derivative problem. Kranzler also mentions a sudden firing of Deutsche Bank executives. He thinks this suggests that some not yet defined derivative blow up could in fact be under the surface right now. In fact, one of the two executives that just resigned suddenly, one of those two was just promoted a couple of weeks ago and then suddenly fired. Well, he resigned, but you can read between the lines, probably fired under pressure. Indeed, it is interesting to note that it was the German Bund that first started to rise precipitously. Its rates started to rise very dramatically, and now, of course, recently the Treasury markets have risen through some key resistance levels on interest rates as well. And we hope to we expect to be talking to Michael Oliver in just a few minutes to see what his charts are telling him about the Treasury markets and the Bund markets and some other key markets. A fourth point that David Kranzler mentioned was that there's a hedge fund manager, Paul Singer, of Elliott Manager, whom David said he knew when David, was a bond trader. And he quotes Singer as saying, quote, "The best trade in a generation is to short long-term claims on paper." End of quote. In other words, it would be stocks and bonds, that sort of thing. David speculates that Singer is no doubt working off some information that is not yet widely circulated in the markets. Then there was also some information put out by Charles Hugh Smith showing that since quantitative easing was phased out at the end of last year, well, guess what? We've had, as I just mentioned, a negative GDP of 0.7%. And during that time, corporate profits sank 5.9%. That's the biggest drop in corporate profits since 2008, that disastrous year of 2008. He also mentions that the value of manufactured new orders for consumer goods has fallen off the charts and looks exactly like it did prior to the 2008-2009 market crash. And David Jensen also sent a chart along that shows massive inventory buildup because sales just simply aren't there. Now, there could be some of that due to excessive oil production, but there's more than that, it would seem. Also, David Kranzler also sent along a suggestion that things are starting to turn bad and ugly again in the housing market. We'll be revisiting that issue a little bit later in the weeks to come. Well, certainly one thing that I've noticed is that countries around the world are running away from the dollar, especially since 2008, 2009. The portion of U.S. dollar liquidity that's held by foreign central banks has fallen very dramatically. In fact, it looks very much like that decline in U.S. Treasuries overall by the inside dealers. Well, in this case, the central banks have declined their holdings of U.S. dollars very dramatically, such that the U.S. government, or let's say the Treasury or the Federal Reserve, is holding U.S. debt now en masse. And so it's not surprising that the BRIC countries, the ones that have been deemed rogue nations by the United States, countries that don't want to submit to the American economic policies, China, Russia, and the other BRICS. Well, Russia is reportedly now studying ways to exchange its dollar-denominated debt in favor of Chinese yuan-denominated debt. Clearly, the sanctions that are being imposed on Russia is pushing Russia into the arms of China. There can be no doubt about that. And those countries are trying to find ways to protect themselves against the onslaught of American hegemony. So we will see, very interestingly, I think the big question in my mind is, in fact, are central banks, in fact, losing control of the credit markets and the interest rates, the sovereign debt markets? If that, in fact, is happening, then I think that we will be looking at some very dramatic changes, tectonic shifts, if you will, in the markets. And we'll be looking to talk to Michael Oliver in just a couple of minutes here after our first break to get his take on some of the latest and some of the most important markets. I have titled today's show really having to do with finding ways to protect ourselves from growing wars and inflation. There's certainly the war cycle is certainly well documented. The United States and the NATO is getting involved in wars all throughout the Middle East. And so we're going to talk to Richard Maybury, who has a tremendous background and I think tremendous history, a knowledge of history. You know, we talk to a lot of people on this show, Austrian economists, people who see the world through the view of free market economics and Austrian economics. But I don't know of anybody who is both an Austrian thinker, an Austrian economics thinker, as well as someone who is as well versed in history as Richard Maybury. So we're going to talk to Richard about some of the issues that are really coming up, and some of the ways that Richard thinks we can best protect ourselves against the onslaught of economic disaster. For those of us who see the world through the lens of Austrian economics, we think it's a foregone conclusion. There cannot be any soft landing. The further down this path we go of trying to print our way out of trouble, the bigger trouble we dig ourselves into. It's like trying to dig yourself out of quicksand. The more you struggle, the faster you go down. So unfortunately, that's a very minority view, of course. Otherwise, policy might be different. But we do want to try to understand what is really going on as opposed to what the propaganda artists are trying to convince us is going on.